In this video you will be given a clear guide on how to generate $4,000 a month in passive income with dividend stocks. This will be your roadmap to financial freedom. Before we dive in, do me this one favor: if advertisements should interrupt this video, please, do not click off of the advertisements. Please allow them to play through as a thank you for sharing with you this valuable information. Now let's continue. Hey there, future financially free individual. This is your personal invitation to unlock a secret that has empowered countless people to live life on their terms. Imagine waking up each month to an extra $4,000 hitting your bank account, not from a job, not from a side hustle, but from your money working tirelessly for you. That's $48,000 a year in pure passive income. Sounds like a dream, right? Well, it's not. It's the power of dividend investing, and in the next 30 minutes, I'm going to show you exactly how to make that dream your reality. Whether you're planning for a comfortable retirement, looking for financial flexibility, or simply want to escape the daily grind, this is your roadmap. Let's dive in. Understanding the foundation. What is passive income, and why you need it? So, what exactly is this magical thing called passive income? Forget the myth that you have to work tirelessly until you're 65. Passive income is money that flows into your life with minimal ongoing effort. Think of it like planting a money tree. You do the initial work of planting and nurturing, but then, year after year, it simply yields fruit for you. No more trading your precious time for dollars. Now, among the many ways to generate passive income, like real estate or online courses, dividend stocks are, in my opinion, one of the most reliable and accessible avenues. So, what are dividends? Picture this: when you buy a share of a company's stock, you become a tiny part owner. And when that company makes a profit, they often share a piece of that profit with their shareholders. That's your dividend. It's literally money paid directly to you, usually every 3 months, just for owning their stock. It's like a thank you check in your mailbox, but way better because it keeps coming. The big picture. How $4,000 a month becomes your reality. Okay, you might be thinking, $4,000 a month sounds amazing, but how much do I actually need to invest to get there? Great question. This is where we do a little math, but don't worry, it's simple and empowering. To pull in $4,000 per month, which totals $48,000 every single year, we need to understand something called dividend yield. This is just the annual dividend payment as a percentage of the stock's price. For example, if a company's stock costs $100 and it pays you $4 per year in dividends, its dividend yield is 4%. So, to hit our $48,000 annual target with an average portfolio yield of, let's say, 4%, you'd need to invest around $1,200,000. Yes, that's a significant number, and I know it might sound daunting right now. But hold on. This isn't about getting rich overnight. This is about building wealth strategically, over time. Think of it not as a mountain to climb in one go, but as a journey where each step, each investment, brings you closer to the summit. We're going to talk about how you build up to that number, piece by piece, starting today. Choosing your income engines, the best dividend companies. So, which companies are sending out these delightful checks? We're not looking for the flashy, high-flying tech startups here. Instead, we're seeking out the quiet giants, the bedrock of the economy. Think about the companies whose products or services you use every single day, regardless of what the economy is doing. I'm talking about established, financially robust businesses with a proven history of not just making profits, but sharing those profits consistently. These are often called blue-chip stocks. For example, consider Procter & Gamble. They make everyday essentials like Tide detergent, Gillette razors, and Crest toothpaste. People buy these things no matter what. Or look at a utility company like Duke Energy, DUK, everyone needs electricity. These are the kinds of stable, predictable businesses that generate reliable cash flow, which they can then distribute to you, their loyal shareholder. They're like the dependable friends in your portfolio, always showing up with a little gift. Why dividends are your superpower, compounding your way to wealth. You might be wondering, why should I focus on dividend stocks when there are so many other ways to invest? Here's the secret sauce: dividend stocks offer a powerful one-two punch. Not only can the value of the stock itself grow over time, that's called capital appreciation, but you also get that regular income stream. But here's where it gets really exciting: you can put those dividends to work for you. Instead of cashing out those quarterly payments, you can reinvest them to buy more shares of the same stock. This is called dividend reinvestment, often simply referred to as a DRIP, a dividend reinvestment plan. Every time you reinvest, you acquire more shares, which then generate even more dividends, which then buy even more shares. It's a powerful snowball effect, accelerating your wealth faster than you might imagine. This is the magic of compounding, and it's the closest thing to printing your own money legally. For every 10 years you let your dividends compound, it's like adding another decade of effort without lifting a finger. Your investment toolkit. How to pick winning dividend stocks. Alright, you're ready to start building your dividend empire. But how do you pick the right companies? This isn't guesswork, it's a discipled approach. Think of yourself as a detective, looking for clues. The track record test. First, look for companies with a long, consistent history of paying and, ideally, increasing their dividends. We're talking about companies that have raised their dividend year after year, for perhaps 10, 25, or even 50 consecutive years. These are often called dividend aristocrats or dividend kings. For example, Johnson & Johnson has increased its dividend for over 60 consecutive years. That shows incredible financial resilience and a shareholder-friendly philosophy. This consistency tells you they're committed to sharing their success with you. The payout ratio check. Next, you want to peek under the hood at the dividend payout ratio. This is simply the percentage of a company's earnings that it pays out as dividends. A healthy ratio is typically between 40% and 60%. If a company is paying out, say, 90% of its earnings as dividends, that's a red flag. It means they might not have enough left over for growth or to weather a tough patch. On the flip side, if the ratio is too low, say 20%, they might have room to increase their dividend in the future, which is a bonus for you. Financial health deep dive. You wouldn't lend money to a friend who's constantly broke, right? The same goes for companies. Look at their overall financial health. Are their revenues growing? Are they consistently profitable? How much debt do they have? Strong revenue growth, healthy profit margins, and manageable debt are crucial. You can find this information on financial websites or the company's investor relations page. You want a company that's not just profitable today, but has the financial muscle to stay profitable for decades to come. Competitive edge, the moat. Finally, consider the company's competitive advantages, what Warren Buffett calls a moat. Does it have a strong brand like Coca-Cola? Unique technology? A dominant market share? These moats protect the company from competitors, ensuring its long-term profitability and its ability to keep those dividend checks flowing. Building your dividend arsenal. Diversification and automation. Now that you know how to pick them, let's talk about building your portfolio. This is absolutely critical. Diversify, diversify, diversify. Think of it like this. You wouldn't put all your eggs in one basket, would you? The same applies to your investments. Spread your money across at least 15 to 20 different dividend-paying stocks, spanning various industries. Don't put all your cash into just one or two sectors, like tech or energy. If one company or industry hits a rough patch, the rest of your diversified portfolio acts as a safety net, keeping your income stream steady. For example, instead of just owning a utility company, you might also own shares in a consumer staple company like PepsiCo, Pep, a healthcare giant like AbbVie, and a financial institution like JP Morgan Chase, JPM. This balance is key to long-term success and peace of mind. And here's a tip for getting started and staying consistent. Automate your investments. Seriously, this is a game changer. Set up automatic transfers from your checking account to your investment account every payday. Even if it's just $50 or $100 to start, consistency is king. This strategy is called dollar cost averaging, and it's brilliant because you'll automatically buy more shares when prices are low and fewer when prices are high, smoothing out your average purchase price over time. You don't have to worry about timing the market, just set it and forget it. Turbocharging your progress. Retirement accounts and patience. To really accelerate your journey to $4,000 a month in passive income, you need to leverage the power of retirement accounts. If your employer offers a 401k, especially with an employer match, contribute at least enough to get that full match. It's literally free money, and it's tax advantaged. Also, explore opening a Roth IRA or a traditional IRA. These accounts offer incredible tax benefits that help your money grow even faster, tax-deferred or even tax-free. They are tailor-made for building long-term wealth and, eventually, a robust passive income stream for retirement. And here's perhaps the most important ingredient: patience. Investing isn't a get-rich-quick scheme. It's a marathon, not a sprint. The earlier you start, the more time compounding has to work its magic. Even small, consistent contributions made when you're young can blossom into a massive nest egg by the time you reach retirement. Common traps to avoid and how to sidestep them. Now, let's talk about some potholes on the road to dividend riches. We want to avoid these at all costs. Don't chase high yields blindly. A stock offering a ridiculously high dividend yield, say 10% or more, often sounds too good to be true. And usually, it is. A super high yield can be a sign that the company's stock price has plummeted because the market thinks the company is in trouble, and that high dividend is simply unsustainable. It's better to have a moderate, growing dividend from a stable company than a sky-high one that gets cut or eliminated. Always investigate why a yield is so high. Avoid sector concentration. We talked about diversification, and this ties in. Don't put all your investment eggs into one single industry. If you only invest in oil and gas companies, and oil prices crash, your income could take a massive hit. Spread your bets across various sectors like consumer goods, healthcare, technology, and utilities to protect your income flow. Don't forget about fundamentals. Even if a company has a great dividend history, its financial health can change. Life happens. Regularly review the financial reports of the companies you own. Make sure they're still profitable, managing debt, and generating enough cash flow to keep those dividends coming. This isn't a set it and forget it strategy entirely. Think of it as periodic checkups for your money tree. The mindset of a successful investor. Staying the course. Investing isn't just about numbers, it's also about managing your emotions. The market will go up, and it will go down. You'll hear scary headlines. You'll see your portfolio fluctuate. But the most successful investors are the ones who stay calm and stick to their plan. When the market has a bad day or even a bad year, it can feel unsettling. However, for dividend investors, a downturn can actually be an opportunity. When stock prices fall, assuming the company's dividend payment stays the same, the dividend yield actually goes up. This means your reinvested dividends buy more shares at a lower price. So, when the market eventually recovers, you own a larger piece of the pie and are positioned for even greater income. Just remember, time in the market beats timing the market. Keep your long-term vision clear. Your future, your freedom. The power of $4,000 a month. Let's wrap this up by truly visualizing what $4,000 per month in passive income could mean for your life. For our older audience listeners, this isn't just about making money, it's about peace of mind in retirement. Imagine your core monthly expenses, your mortgage, utilities, groceries, even some travel, all covered by your dividend checks. You're not reliant solely on Social Security or constantly worried about selling off your nest egg. This consistent, predictable income gives you the freedom to truly enjoy your golden years, pursue your passions, and spend quality time with loved ones, completely on your own terms. It's about replacing your earned income with unearned income. And for our younger audience, this is about building a foundation for true financial independence, potentially much earlier than retirement age. Think about it. If you start investing consistently now, leveraging compounding, that $4,000 a month could be a reality in your 40s or 50s. Imagine the choices that would open up for you, leaving a stressful job, starting your own business, traveling the world, or simply choosing to work less and enjoy life more. This isn't just about money, it's about buying your freedom and your time. Your next steps. Taking action today. You now have the knowledge and the roadmap. The next step is to take action. Open an investment account. If you don't have one, open a brokerage account. Look for online brokers that offer low fees and the option for dividend reinvestment plans. Start small, start now, don't wait. Even if it's just $50 or $100 a month, begin automating those investments. Research your first dividend stocks, pick 2 to 3 companies from different sectors that meet the criteria we discussed: long dividend history, healthy payout ratio, strong financials, and a competitive moat. Stay consistent, stay patient. This is a long-term game. Keep contributing, keep reinvesting, and trust the process. The journey to $4,000 a month in passive income through dividend stocks is absolutely achievable. It takes discipline, patience, and the insights you've gained today. Your financial future is in your hands. Are you ready to build it? Please subscribe to this channel for more videos like this. Like and comment below. In this video you will be given a clear guide.